The moment a trader enters a trade, something dramatic happens inside the brain. Before the candle even forms, before the price even moves a single pip, the mind is already rewriting reality. A second ago you were calm, analyzing structure, marking zones, measuring risk to reward, but the instant your finger tapped the buy or sell button, your emotional system took command as if a switch flipped. And the most fascinating part is that it doesn't matter whether you are a beginner or advanced. That moment is universal. The first second after entry is where the real battle begins. A trader looking at a chart is not the same trader after entering the market. The shift is fast, automatic, and rooted in human survival instincts. When you are scanning the chart, you are using your logical brain. When you enter, you activate the emotional brain. These two parts cannot dominate at the same time. The emotional brain is older, more powerful, and always prepared to override logic if it senses danger or opportunity. To the emotional brain, entering a trade is not just clicking a button. It feels like stepping into a fight. It feels like something is at risk. Money is tied to survival, identity, ego, and pride, so the brain reacts as if a threat has arrived. Imagine a hunter thousands of years ago. Before the hunt, he can plan, think, strategize, and evaluate. But once he steps into the forest and hears a branch crack, the planning brain disappears and instinct takes over. Trading activates the same biological shift. The charts are your forest. The price movement is the crack of the branch, and your entry is the moment you step inside the unknown. The mind hates uncertain situations. It wants immediate confirmation that you made the right choice. This is why you feel tension right after entry. You look for the first candle to validate you. If it moves in your direction, your brain rewards you with dopamine. If it moves against you, your stress levels rise immediately. It is not the size of the move that triggers emotion. It is the meaning your brain attaches to it. A tiny retracement becomes a threat. A small spike becomes hope. Nothing changed in the strategy, but everything changed in the mind. You can see this clearly when you compare yourself before and after pressing buy. Before entry, you can explain your full analysis with confidence. You know your stop loss. You know your target. You understand the structure. You feel disciplined. But after entry, the brain begins to doubt the same analysis you trusted just 1 minute earlier. You find yourself zooming in and out on the chart. You check smaller time frames even if they were never part of the plan. You stare at the candles as if you can control them with your eyes. You refresh your phone. You calculate your floating profit or loss, even though the trade just started. The reason this shift happens is simple but overlooked. The moment you enter, you become emotionally invested instead of intellectually invested. As long as you are analyzing, you are detached from the outcome. Your brain is evaluating possibilities, but when you enter, your brain now expects a result. The chart is no longer a neutral field. It becomes tied to your self-worth. A win gives you validation. A loss gives you pain. And because the mind hates pain more than it loves gain, it becomes hypersensitive the moment money is at risk. This is why many professional traders preach the same idea. Your analysis skills don't matter if your psychology collapses after entry. You must learn to remain the same person before and after clicking the button. If the entry changes your personality, the trade will control you instead of you controlling it. Another powerful force at play is anticipation. Before entering, the brain experiences a mixture of hope, fear, and excitement. But the moment you enter, anticipation turns into uncertainty, and uncertainty turns into emotional tension. Humans are not designed to remain calm in uncertain environments. When the mind cannot predict what will happen next, it assumes danger, and the modern trading environment is built to trigger this danger instinct. The numbers move constantly, the candles flicker, the spread changes, the profit fluctuates every second. The sounds of notifications spike anxiety. The visual movement of red and green activates primal responses deep in the brain. Traders often think they are reacting to strategy, They are reacting to sensory stimulation. Before we dive deeper, let me ask you this. Are you struggling with fear, doubt, or overtrading? The truth is, most people don't fail because of bad strategies. They fail because of bad psychology. That's why I created my ebook, Master Your Mind, Master Your Trades. It's packed with practical steps to control your emotions, stay disciplined, and trade like a pro. Also, I created my full course on trading psychology, risk management, and many more teachings I've put together over my long experience. Everything is in the description below. Now let's continue. You can also see how expectation influences emotion. When you enter a trade, you don't just hope the market will move in your direction. You expect it. You feel like the market owes you because your setup was clean. When the market goes the opposite way, even by 2 pips, your brain interprets it as betrayal. You take it personally. That personal emotion is what creates panic. The market never promised to move in your direction immediately, but your expectations created a fantasy where the trade must work instantly. When reality hits, emotion takes over. And then there is the illusion of control. Traders believe they are in control when they analyze. They believe their knowledge, indicators, risk management, and strategy give them power over the market. But after entering, the truth becomes visible. You have zero control over what the market will do next. The moment you enter, your only real control is your reaction. And because the mind hates losing control, it overreacts to any sign of uncertainty. This is why a tiny candle triggers fear. This is why a wick triggers doubt. This is why the first pullback feels like danger, even though it happens in every normal market movement. A powerful psychological shift also occurs because entering a trade locks you into a position. You are now committed. With commitment comes vulnerability. With vulnerability comes emotional alertness. The brain wants safety. The market provides none. This tension is the real cause of the emotional storm traders experience. There is also the subconscious memory of past pain. Every losing streak, every blown account, every time you held a losing trade too long, your brain stored the emotional memory. When you enter a new trade, your brain automatically compares the current situation to previous painful experiences. It asks, is this another loss coming? Is this another mistake? Is this the same pattern that led to disaster before? Even if you try to be logical, the emotional system scans your history quietly, preparing defense. And its defense mechanism is fear. Fear makes you hyper-aware. Hyper-awareness creates overthinking. Overthinking creates panic. Panic creates irrational decisions. Some traders enter a trade and instantly feel the need to reposition the stop-loss. The candle has not even closed, yet the brain wants to adjust the plan. That impulse is not coming from strategy. It is coming from fear of being wrong. For some, the moment the trade goes into slight drawdown, they feel pressure to close it early. They are not reacting to the chart. They are reacting to the discomfort inside their chest. Others do the opposite. They hold losing trades because closing it confirms failure. Their emotional brain would rather avoid the feeling of being wrong than protect their account. This emotional takeover is not a character flaw. It is biology. Your brain is wired to react emotionally when something valuable is at risk. And in modern society, money feels like survival. Trading puts survival and uncertainty together. This combination forces the emotional brain to dominate. Understanding this is the first step toward control. You can't fix emotional trading by pretending you don't feel anything. You must understand the specific moment when your mind changes. You must learn that the instant after entry is the point where discipline truly begins. The job is no longer analyzing. The job becomes managing yourself. The traders who grow the fastest are those who reduce the emotional shock after entry. They accept that drawdown is normal. They understand that the first candle means nothing. They detach their identity from the result. They treat each trade as one random outcome in a series, not a measure of their skill. This mindset removes pressure. Without pressure, the emotional brain calms down. When the emotional brain calms down, the logical brain takes back control. The key to progress is developing emotional neutrality. Neutrality means you don't expect the trade to win instantly. You don't react to every candle. You don't fight the market. You don't judge yourself for being in drawdown. You watch the chart without attaching fear or excitement to it. This is the state from which disciplined traders operate. Now imagine a trader sitting in front of the chart. He marks his zones, waits for confirmation, and enters calmly. The price moves against him a little, but he doesn't panic. He doesn't zoom in. He doesn't shift to a different time frame. He understands the story the chart is telling. He knows drawdown is part of the journey. He knows his stop loss is placed correctly. His mind stays quiet. His breathing stays steady. His identity is not tied to the trade. He is not trying to prove he is right. He is simply executing his plan. This trader is not emotionless. He has emotions, but he has trained his mind to recognize when the emotional brain tries to take over. He knows the first few seconds after entry are the danger zone. He has developed awareness. He has learned how to step back mentally even while the trade is running. This ability is what separates average traders from consistent ones. The emotional takeover at entry can never fully disappear. It is built into human psychology, but it can be managed, reduced, and even used as a strength. The more you understand this shift, the more power you have during real trading. The market will always test your emotional stability. The candles will always move unpredictably. There will always be uncertainty. But the trader who understands why emotions explode the moment they enter a trade becomes harder to shake. They stop panicking. They stop overreacting. They stop fighting the market. They start observing instead of reacting. And when a trader finally reaches that state, their strategy becomes more effective, their results become more consistent, and their confidence becomes grounded in reality instead of hope. That transformation begins with knowing what truly happens inside the mind the second you enter a trade. And the moment you understand that, you start taking the first real steps toward becoming a disciplined trader who does not get controlled by emotion. A trader can have the cleanest strategy in the world, the sharpest entries, the most perfect support and resistance levels, and still struggle because of the internal war that starts the moment the trade begins to move. This war is not visible on the chart. It happens inside the mind. The chart only exposes the result of the battle, not the process. But every trader feels it. The pull between logic and emotion. The tension between what you planned and what you feel. The quiet chaos that begins right after entry. The mind is complex, but when you enter a trade, it splits into two distinct voices. The first voice is the logical voice. It is calm, structured, and based on your analysis. It knows why you entered. It knows where the market is likely to go. It understands the bigger picture. The second voice is the emotional voice. It is loud, reactive, and driven by fear, excitement, and past trauma. It does not care about structure or confirmation. It cares only about comfort and safety. Before entry, the logical voice is dominant. After entry, the emotional voice fights for control. The moment the candle starts forming, your brain shifts into prediction mode. The mind wants to know where the next candle will close, but the market refuses to give answers. That uncertainty fuels the emotional voice. It gains strength. It tries to convince you that something is wrong, even when nothing is wrong. This is why traders stare at candles hoping to force an outcome. This is why they start questioning the same analysis they trusted 1 minute earlier. Consider a trader watching a clean bullish setup. Strong support, a clear zone, a high probability reversal. The trader waits patiently, finds a confirmation candle, and enters. Logic says the market should go up. But immediately after entry, the market pulls back slightly. A normal move. A tiny retracement. A simple, harmless flicker of price. The logical brain knows this is normal. It expected pullbacks. It planned for them. But the emotional voice interprets it as danger. It whispers, what if this is a reversal? What if you entered too early? What if this is the beginning of a loss? Now the war begins. The logical brain tries to hold its ground. It reminds you of your backtesting. It reminds you of your plan. It reminds you of your strategy. But the emotional voice has something more powerful than logic. It has memory. It has the memory of the time you entered too early and got stopped out. It has the memory of the time a small pullback turned into a massive loss. It has the memory of the time you swore you would stop revenge trading but couldn't. These emotional memories hit faster than logical reasoning. They hit deeper. They hit harder because they trigger survival instincts. This is the mistake many traders make. They think their emotional reactions come from the current trade. Most of the time, they come from past pain that has not been processed. Every loss you didn't emotionally resolve stays inside your subconscious. Every time you held a losing trade until it wiped your account, your nervous system stored that experience. So when you enter a new trade and see a tiny pullback, the emotional brain activates those stored memories as if they are happening again. This is why traders panic too early. This is why they expect the worst even when the setup is clean. It is not the chart they are reacting to, it is their history. As the internal war continues, the market keeps doing what it always does. Moving up and down, creating noise, never moving in a straight line. But to the emotional mind, every flicker signals danger or hope. This creates a pattern. When the market moves slightly in profit, the trader relaxes. When it pulls back even a little, tension returns. This emotional roller coaster drains mental energy. A trader who started the day thinking clearly slowly becomes reactive, stressed, and impatient. This emotional fatigue is dangerous because it weakens your discipline. A tired mind can't hold logical decisions for long. The emotional brain waits for these moments. It strikes when the trader is tired, overstimulated, or overwhelmed. The more drained you are, the easier it becomes to make decisions based on fear instead of logic. This is why traders who analyze perfectly during the weekend can't trade properly during live markets. The emotional overload destroys the mental clarity they had earlier. The internal war is also influenced by the illusion of short-term control. Before entering, traders feel in control. They can decide when to enter, where to place a stop loss, which pairs to trade, and which zones to use. But once the trade begins, control ends. The trader is now reacting, not controlling. The market does what it wants. The candles do not respond to your plan. The spread widens unpredictably. News spikes randomness. Algorithmic movements create unexpected wicks. Losing control is extremely uncomfortable for the human mind. We are wired to avoid uncertainty. When people feel out of control, anxiety appears. When anxiety appears, the emotional brain tries to take full command. It attempts to force control through irrational actions. Closing early, moving stop loss, re-entering impulsively, adding unnecessary indicators, checking lower time frames, over-monitoring every pip. These behaviors give the illusion of control but actually sabotage the trade. Many traders confuse activity with control. They think doing more means protecting the trade. In reality, the more a trader interferes with a trade, the more emotional the mind becomes. True control comes from letting the plan play out. It comes from accepting that the outcome is outside your power. It comes from trusting the process instead of fighting the market. Another factor in this internal war is the ego. Even if you try to remove ego from trading, it still hides in decisions. The ego wants to be right. It hates being wrong. And when you enter a trade, the outcome becomes a direct threat to the ego. A losing trade is not just a financial loss. It feels like personal failure. So the ego tries to protect itself by pushing emotional decisions. It wants to close early when the trade is in small profit. It wants to hold losers longer than necessary because admitting the loss feels painful. It wants to avoid being wrong more than it wants to make money. This ego-driven emotional response explains why many traders break their rules even when they know better. They are not fighting the chart. They are fighting their own identity. A consistent trader must reduce the role of ego until the outcome of a trade no longer defines them. When a trader does not attach self-worth to results, emotions lose power and logic becomes stronger. The internal war also gets stronger when traders are trading money they cannot afford to lose, or money tied to emotional goals. When the rent is due, when a debt is waiting, when the desire to flip an account becomes too strong, when the pressure to perform increases. These emotional attachments to money amplify every movement in the chart. A $5 drawdown feels like danger. A $10 profit feels like relief. A small rejection candle looks like a collapse. The market becomes a battlefield of personal stress instead of just probabilities. The traders who remain calm during trades understand something fundamental. The market is neutral. It does not care about your goals, your needs, your dreams, or your fears. It is not against you. It is not testing you. It is not trying to teach you a lesson. It is simply moving. The emotional brain makes it personal. When you lose, it tells you the market betrayed you. When you win, it tells you the market rewarded you. But the market did nothing. It simply moved according to its structure. When a trader accepts this neutrality, emotional pressure reduces significantly. Another powerful aspect of this internal war is the obsession with being perfect. Many traders believe that if they stick to their rules perfectly, every trade should play out cleanly. But perfection does not exist in trading. A perfect entry can still lose. A perfect confirmation can still get invalidated. A perfect zone can still be swept. And when traders expect perfection, they panic when the market behaves normally. They interpret normal pullbacks as invalidations. They interpret consolidation as weakness. They interpret liquidity grabs as failure. Perfectionism turns minor movements into emotional triggers. It makes traders think they are wrong too early. It makes them distrust their own system. It makes them sabotage winning trades. The path to emotional stability is accepting imperfection. Accepting that a strategy is about probabilities, not perfection. Accepting that even the best setups can lose. Accepting that discomfort is part of the journey. When traders finally understand this internal war, they recognize that winning trades are not the real victory. The real victory is staying calm while the trade runs. The real victory is allowing logic to dominate emotion. The real victory is trusting your plan during uncertainty. Every time you resist the emotional voice and follow the logical one, you strengthen mental discipline. Every time you allow emotion to take over, you weaken your confidence and reinforce fear-based behavior. Imagine a trader who has mastered this internal balance. He enters a trade and remains steady. The market pulls back. His breathing stays calm. His face doesn't change. His mind does not panic. The emotional voice whispers, but he does not feed it. He watches price move with detached awareness. The logical voice stays in control because he trained his mind to remain stable under uncertainty. This trader is dangerous in the best way. He is unshaken by typical market noise. His confidence is grounded in discipline, not results. This internal mastery does not happen overnight. It builds through repetition. It builds through emotional awareness. It builds through accepting losses without self-punishment. It builds through treating each trade as part of a long-term game. It builds through trusting your framework more than your feelings. When a trader reaches this level of mental strength, the market stops being overwhelming. Losses no longer hurt the same way. Wins no longer inflate the ego. The chart becomes clearer. The noise becomes quieter. And the emotional brain begins to surrender to the logical brain more often. The war never disappears completely. Emotion will always exist. But it becomes manageable. It becomes weaker. It loses its power to sabotage your trades. And once emotion loses its power, you begin to trade like someone who is no longer a slave to fear. This is the beginning of trading mastery. The moment when logic begins to consistently overcome emotion. The moment when a trader stops being controlled by the chart and starts controlling themselves. And that shift changes everything. There comes a point in every trader's journey where knowledge is no longer the problem. You know your entries, you understand your setups, you've studied price action, you've learned risk management, you've seen the same patterns repeat thousands of times on the chart. Yet somehow, when the trade goes live, everything you know breaks down. The market starts moving, and your emotions begin driving the car while your logic gets pushed into the back seat. This final chapter focuses on what every trader eventually wants but rarely achieves. Complete psychological control during the trade. Not control over the market, not control over the candles, but control over yourself, which is the only thing that actually matters. The first key to taking back control is understanding that the emotional reaction you feel when a trade becomes live is a physiological response, not a strategic one. Your nervous system activates as if you are in danger. Your breathing shallowly shortens. Your muscles tense. Your mind begins scanning rapidly for threats. The moment you enter a trade, your brain interprets the situation as risk to your survival, because money, over generations, became linked to safety. Losing money feels like losing safety. That is why even the smallest drawdowns create fear, tension, and overthinking. You cannot overcome this response with willpower alone. You cannot force yourself to be calm by telling yourself to relax. The nervous system does not listen to words. It listens to patterns. If your pattern is panic, your mind will panic. If your pattern is control, your mind will learn control. True mastery comes from conditioning, not motivation. The next step is learning to regulate yourself before entering the market. Most traders enter trades already emotionally unstable. They come from stress, impatience, external pressure, financial worry, or the desire to flip an account. Entering a trade in that state is like pouring gasoline on an open flame. The emotional explosion is automatic. You cannot fight fire once you're already inside it. You prevent the fire before entering the market. The most consistent traders have a ritual before every trading session, not because it looks professional, but because it stabilizes the mind. A calm mind makes logical decisions. A chaotic mind makes emotional decisions. A simple ritual of breathing, reviewing your rules, reminding yourself of your risk, and confirming that you are not trading money tied to pressure, creates a mental reset that prepares the brain for uncertainty. You begin the session grounded instead of reactive. Another critical aspect of control is redefining what a trade represents. Most traders see a trade as a make or break event. They see it as an opportunity to win or an opportunity to lose. This creates emotional attachment. A professional trader sees every trade as one small sample out of thousands they will take in their lifetime. One trade is meaningless. One outcome does not define them. One candle does not decide their future. When a trader truly internalizes this, the emotional weight of every entry decreases dramatically. You stop expecting one trade to validate your skill. You stop expecting one setup to prove your worth. You stop reacting to every pullback like it threatens your identity. You begin to see trading as a long-term process rather than an event-by-event emotional roller coaster. Control also comes from trusting probability. Many traders think they trust their strategy, but they actually trust their feelings. When the trade goes into profit, they believe the setup is correct. When the trade pulls back, they suddenly believe their analysis is wrong. This is emotional thinking disguised as analysis. A real trader trusts the process, not the mood of the moment. The market is built on randomness, noise, and uncertainty. Even the best setups have losing moments. Even the strongest trends have violent pullbacks. Even clean breakouts retest in unexpected ways. When a trader expects clarity, they panic during uncertainty. When a trader expects noise, they remain calm because noise no longer surprises them. Another important step is recognizing the difference between discomfort and danger. These are not the same. Discomfort is normal, danger is rare. Most traders react to discomfort as if it is danger. They see a small pullback and feel threatened. They see a temporary rejection and assume a reversal. They see consolidation and think something is wrong. But discomfort is part of the natural movement of the market. It is not a reason to panic, it is a reason to stay patient. Mastery begins when you stop solving discomfort and start accepting it. You breathe through it. You observe it. You let the candle do what it wants. You stop giving meaning to every small movement. When you stop trying to fix discomfort, you stop making emotional decisions that sabotage your trade. Taking back control also requires learning how to detach your personal life from your trading decisions. If you enter the market with financial stress, relationship problems, school pressure, or emotional instability, the market will magnify it. The chart does not make you emotional. It reveals the emotions you enter with. The cleaner your internal state, the clearer your trading becomes. The more unstable your internal state, the more chaotic the chart appears. This is why many traders mistake emotional clarity for strategy clarity. They think they need a new strategy when what they actually need is mental stability. A calm trader can see opportunities clearly with the same strategy others fail with. A stressed trader will ruin even the best system. Emotional control is the hidden multiplier of profitability. One of the most powerful tools to regain control is predefining your behavior before the trade. Professionals do not decide how to act during the trade. They decide before the trade. When the rules are decided ahead of time, emotion has no room to negotiate. Without predefined rules, emotion wins every argument because it speaks louder and faster than logic. Your plan should include your entry, stop loss, take profit, risk percentage, reasons for entry, invalidation conditions, and emotional expectations. When your mind knows exactly what to expect, uncertainty decreases. When uncertainty decreases, emotional reactions weaken. You cannot eliminate unpredictability, but you can eliminate indecision. A powerful shift happens when a trader stops trying to eliminate emotions and starts learning to operate through them. Emotions are not the enemy. Emotional decisions are. You can feel fear and still follow your plan. You can feel uncertainty and still let the trade run. You can feel discomfort and still remain calm. The goal is not to become emotionless. The goal is to become emotionally disciplined. Another foundation of emotional control is building trust with yourself. Every time you follow your rules, your internal confidence grows. Every time you break your rules, your confidence weakens. When your confidence weakens, emotions become stronger. A trader who does not trust themselves will always panic because they know they do not have a reliable internal guide. A trader who trusts themselves does not panic because they know they have built discipline. It is impossible to control your mind if you constantly betray your own system. Emotional stability is a reward given to disciplined traders, not to inconsistent ones. Consistency creates confidence. Confidence creates clarity. Clarity creates calmness. Calmness creates control. One of the most overlooked skills is learning how to separate the trade from the outcome. Most traders emotionally attach to the outcome. If the trade wins, they feel good. If the trade loses, they feel bad. This attachment gives the outcome emotional power. When the outcome has power, the emotional voice dominates during the trade. The way to fix this is simple, but not easy. Judge yourself based on execution, not results. If you followed your plan perfectly and the trade lost, that is success. If you broke your plan and the trade won, that is failure. This mindset removes the emotional attachment to results and replaces it with logical measurement. When your focus shifts from winning to executing, the pressure disappears. Without pressure, emotional impulses weaken. Taking back control of your mind also requires removing unnecessary noise. Many traders sabotage themselves by checking multiple time frames, indicators, signals, and opinions while the trade is running. This creates confusion. Confusion creates hesitation. Hesitation creates fear. Fear creates emotional decisions. You cannot stabilize your mind when your environment is noisy. The cleaner your chart, the cleaner your mind. The cleaner your mind, the cleaner your trades. Another powerful method to gain control is mastering emotional awareness. When traders feel emotion, they react instantly without understanding what triggered it. But when you pause for a second and identify the emotion, its power decreases. The moment you name what you feel, your conscious mind becomes active and your emotional mind becomes weaker. Naming emotions activates logic. Logic calms reactions. You may experience fear, impatience, excitement, doubt, or the fear of missing out. By recognizing the emotion instead of reacting blindly, you create a mental gap. That gap is where discipline lives. That gap is where you stop sabotaging yourself. Visualization is also a strong tool for internal control. The most disciplined traders mentally rehearse calm responses before entering the market. They imagine scenarios where the trade pulls back, rejects the level, consolidates, or goes against them temporarily. By mentally facing these moments before they happen, the brain becomes prepared. When the actual moment arrives, the emotional shock is reduced. The mind responds instead of reacting. A trader who wants control must also become comfortable with letting the market breathe. The market needs space to move. It needs room to fluctuate. It needs freedom to decide direction. When traders expect perfect movement, they suffocate the trade. They monitor too closely. They react too quickly. They interfere too aggressively. Letting the market breathe means accepting uncertainty as part of the process. Finally, genuine control comes from accepting the most important truth of all. The market does not owe you anything. The market does not reward neediness. The market does not respond to desperation. The market does not care how much you want to win. The only thing you can control is your decisions. When you stop trying to control the market and focus on controlling yourself, emotional stability becomes natural. Your job is not to predict every candle. Your job is to manage your behavior. Your power is not in predicting perfectly. Your power is in staying disciplined under pressure. Winning traders do not have stronger strategies. They have stronger minds. When a trader masters their mind, every trade becomes simple. The chart becomes clearer. The noise becomes quieter. The emotional voice becomes weaker. Logic becomes stronger. Confidence becomes natural. And the market becomes less intimidating. You stop shaking when price moves. You stop panicking during pullbacks. You stop cutting trades early. You stop rushing entries. You stop reacting. You begin responding. You begin observing. You begin trusting your plan. You begin acting like someone who is no longer controlled by fear. This is the transformation that separates losing traders from consistent ones. It is not knowledge, it is not indicators, it is not strategies. It is emotional mastery. And once you take back control of your mind, the market becomes easier not because the market changed, but because you changed.